Market pundits often chase their tails and the so-called hot dot, attempting to beat the market averages. But evidence indicates that is very hard to do consistently over time. Costs are friction. They're a headwind, and they include taxes, fees, and transaction expenses. In fact, the number one predictor of returns over time is cost. There are very few tried and true ways of outperforming the market averages over time, but there are a few. Academic research has identified 5 dimensions of return that correspond to higher returns over time, 3 in the equity markets and 2 in the fixed income markets. In the fixed income space, credit quality and average maturity are the only 2 dimensions of returns that work consistently. Let's go back to equities for a second. Small company stocks will outperform large company stocks to the tune of about 2.5% per year on average over time. That's because they're riskier. Think TGI Fridays versus Walmart, or O'Charley's versus General Electric. If you own a lot of small company stocks, you're negating this individual stock risk, but you're getting the benefit of that outperformance of the asset class. Value stocks outperform growth stocks. Well, that's just a style nomenclature. Value can mean lower price to book value, and growth typically, while they're growing faster, you pay up more and they have a higher price per share divided by the book value per share. Again, value stocks are riskier, and that's why they return more. They get about 4% a year, closer to 5% a year per average over time, value over growth. The third dimension in equities is higher profit companies will outperform lower profit companies over time. We've always known that stocks go as earnings go. Well, now we can measure that through computer technology much more readily and assign a value and pick those companies that have higher profit margin. And there is a predictive nature to that. It is a dimension of return, of higher return. In the fixed income space, higher quality stocks rated A, for example, or AA or AAA versus lower quality stocks, such as high yield stocks, well, sometimes you get paid for taking on the risk of buying low quality, sometimes you don't. So you have to look at the so-called spreads. If the spreads are wide, buy low quality fixed income. If the spreads are narrow, swap out and buy higher quality fixed income funds. Same for maturity. If the yield curve is steep, then you can extend your maturity longer. But if the yield curve is flat, you're not getting paid to go longer, so you bring in your maturity. Those 2 elements of fixed income will help your returns in the fixed income space to the tune of about 1 to 1.5% a year.